Gold just did something it wasn't supposed to do. The dollar fell. Headlines were calm. Inflation came in soft. But gold? It surged anyway, blowing past 33.50 and dragging silent signals with it. Traders are split. Hedge funds just made a rare double-sided bet. Central banks are stacking more, and retail still sleeping. But here's the truth. This wasn't a random move. This week, a series of quiet but coordinated events reshaped the entire outlook for gold, from Trump's surprise tariff threat to China's silent accumulation to a credit downgrade that most people ignored. And if you know where to look, the clues are everywhere. From a suppressed dollar to a breakout setup that might already be halfway done. In this video, we're going to uncover every layer. The price, the positioning, the real moves behind the headlines, and the key dates next week that could send shockwaves through the gold market again. You're watching Don Gilded, where we chase the metal, not the hype. Don't forget to like, share, and subscribe. Let's start with the number that stunned the market. As of Monday morning, gold was trading at $3,229.67 per ounce. By Friday afternoon, it closed at $3,357.34. That's a 1-week increase of $127.67, a jump of nearly 4% in just 5 days. And it wasn't a fluke, because the dollar, the thing that usually moves against gold, dropped too. The US dollar index opened the week at 100.29. By Friday, it was down to 99.01, a 1.3% slide. That's not coincidence, that's correlation. When the dollar weakens, gold becomes cheaper in other currencies. That draws in foreign buyers and adds pressure to the upside. But this week's move had more behind it than just Forex mechanics. Because on Friday, something political happened that rippled through every market on the planet. Donald Trump announced a 50% tariff on all European Union imports, set to take effect on June 1st.
We've set the deal, it's at 50%. But again, there is no tariff if they build their plant here.
His reasoning? Trade imbalance, unfair conditions, the usual playbook.
They've treated us very badly over the years. It was formed in order to hurt the United States, in order to take advantage of the United States, and they've done that. We have a big deficit with them. They sell millions and millions of cars, as you know, Mercedes and BMW and Volkswagen and many others, and we were restricted from, essentially restricted from selling cars into the European Union, which is not nice. And I just said, it's time that we play the game the way I know how to play the game.
But the markets didn't care why. They cared how fast. The EU responded immediately, promising retaliation and warning of escalating tension. Within hours, stocks dipped, the dollar slipped further, and safe havens like gold started rising. Because when world powers start taxing each other's economies, the foundation shakes. Trust between currencies breaks down, and gold becomes the bridge no one can censor, freeze, or devalue. While the headlines focused on tariffs, another move was happening in silence. China continued stacking gold. According to the World Gold Council, the People's Bank of China added 2.2 metric tons of gold in April, marking its 6th consecutive month of accumulation. Officially, their reserves now stand over 5,000 tons. But unofficially, many analysts believe it's far higher. Why would a country with massive dollar holdings quietly keep buying gold? Because they're not just hedging inflation, they're hedging the system. Every ounce they buy is a vote against fiat fragility, a vote for sovereign control. And when one of the world's largest economies does that consistently, it's not just a signal, it's a strategy. Meanwhile, over in the futures market, another layer was building. The Commitment of Traders report, released Tuesday, May 20th, showed something rare. Hedge funds, categorized under managed money, added 6,100 long contracts, but they also added nearly 4,900 short contracts. That's not conviction, that's defense. They're bracing for volatility, playing both sides, expecting something to snap. On the other hand, swap dealers, the institutions that act as the middlemen, added over 10,000 long contracts. These are the players who usually get in position before a big move. Even more interesting, a category called other reportables, usually family offices and institutional traders, reduced their short exposure by over 1,200 contracts. That's not a panic exit, that's a careful pullback. A soft signal that the risk of further downside may be fading. And if you overlay this with the price action, the chart starts speaking its own language. On the 1-day time frame, gold is forming something called a cup and handle pattern. It sounds weird, but picture it like this. You take a coffee mug. The rounded bottom is the big dip and recovery. That's the cup. Then you tilt the mug just a bit, and it forms a smaller dip to the side. That's the handle. In trading, this shape often shows up when buyers are building strength. First, gold rallies. Then it pulls back just a bit, not crashing, just resting. Then, if enough buyers step in, it breaks out of the top of the cup. Right now, that breakout line is around 33.70. If gold pushes through that level with momentum, It could launch toward the all-time high at 34.40. Now zoom into the 4-hour chart. That just means we're looking at a smaller time frame. Each candle shows 4 hours instead of a full day. What we see there is even more telling. Every time gold climbed this week, the volume, or how many people were buying, surged. But every time it pulled back, that volume dropped. That's called bullish volume divergence. It means buyers are getting more confident and sellers are getting tired. Think of it like a boxing match. One fighter is still swinging hard every round. The other one is stepping back, breathing heavier, losing steam. That's what the chart is saying. And here's why this matters, even if you don't trade. Technical analysis isn't magic. It's not fortune telling. It's just human behavior in numbers. When enough people see the same setup and believe in the same breakout, it becomes a self-fulfilling prophecy. That's why we watch levels like 33.70. Not because it guarantees anything, but because if gold breaks it, a lot of traders will pile in at the same time. That's what turns a quiet move into a sprint. And this week, that sprint might already be lining up. But even that wasn't the biggest red flag. On Friday, May 16th, Moody's downgraded the U.S. credit rating from AAA to AA1. Their reasoning? Soaring national debt, now over $36 trillion, and lack of meaningful deficit reduction. The timing of this downgrade couldn't have been more volatile, because just days after the announcement, bond yields spiked. The 30-year Treasury yield surged past 5% for the first time in 18 months. That sent equity markets down. The VIX index, which measures volatility, jumped sharply, and as the fear index spiked, investors did what they always do when the system looks wobbly. They turned to gold, because unlike stocks or treasuries, gold doesn't care about ratings, or elections, or debt ceilings. It just reflects trust, or lack of it. And this week, the system quietly said, don't trust us. Because underneath all of this, beneath the news, the charts, the reports, is one simple truth. Gold doesn't just protect wealth, it reveals it. And this week, it revealed something important. The dollar dropped, tariffs returned, debt spiked, traders hedged, central banks kept buying, and gold quietly climbed 4% and waited for everyone else to notice what it already knew. You don't need to guess the future. You just need to pay attention when the truth starts shining through. Stay sharp, stay sovereign. This was your gold recap. I'm Don Gilded. See you next week. Real quick, if you're the kind of person who doesn't trust the system, who sees the writing on the vault walls, I made something for you. The first official Don Gilded drop is live. These aren't your average shirts. They're a statement, a warning, and a nod to the ones stacking metal while the world burns paper. Links below. Limited supply. Because truth doesn't mass produce. If you're stacking or trading, there are 3 dates you need to circle. First, Tuesday, May 27th, at 10 a.m. Eastern, the Conference Board will release the U.S. Consumer Confidence Index. If confidence drops, it signals growing uncertainty, and that usually means investors turn to gold. But if the number comes in surprisingly strong, it could suggest the economy is holding steady, and that might trigger a short-term pullback. Next, Friday, May 30th, at 8:30 a.m. Eastern. That's when the Bureau of Economic Analysis publishes the Core PCE Price Index. This is the Fed's favorite inflation gauge. If the number is lower than expected, markets may bet on interest rate cuts, and gold could get a lift. But if inflation stays sticky or rises, rate cuts could get pushed back, and that might put some pressure on gold. Also on Friday, May 30th, at 10 a.m. Eastern, the University of Michigan releases its final May Consumer Sentiment Index. Earlier this month, the preliminary reading dropped to 50.8, one of the lowest in over a decade. If the final number confirms that decline, or drops even further, it could spark fresh concern around inflation and tariffs, and that kind of pessimism usually drives gold demand even higher.